The Hilton Hotel LBO by Bryce Whiting, Brad Duncan, Edgar Pavlovsky, and Ryan Jones. In 1927, Hilton Hotels opened its first hotel with cold running water and air conditioning in the public rooms. In 1948, Hilton became the first hotel company to introduce a multi-hotel reservation system and continued to expand its presence in the hospitality industry by creating its first special amenity for female travelers in 1950 and offering its first brand-wide direct dial telephone service in 1957. In 1987, Hilton introduced its guest loyalty program, and in 2008, Hilton Vancouver, Washington made history as the first hotel to be both leadership and energy and environmental design and green seal certified. On July 3, 2007, Hilton Hotels announced an agreement with the Blackstone Group, who agreed to purchase Hilton at $47.48 a share, or a 40% premium. On October 25, 2007, the deal was completed, and Blackstone appointed Christopher Nassetta as the new Hilton CEO. In 2010, Blackstone restructured the financing with additional equity as well as extended loan maturities, and in December of 2013, Blackstone took Hilton public for an IPO of $21.30 a share. Over the last 15 years, Blackstone had been the largest private investor in hospitality worldwide, with a strong track record of reinvesting in its hotel properties. Blackstone invested approximately $1 billion in its LXR properties between 2004 and 2007, and had grown the La Quinta brand by about 45% since its acquisition in January 2006. Blackstone had also acquired Prime Hospitality Corp. And Extended Stay America, investing a total of $17 billion in the hotel industry from 2004 to 2007. Blackstone sought to continue its investment in the real estate industry and intended to invest in the Hilton properties and brands to grow and enhance business for its stakeholders. The real estate industry was experiencing what seemed to be a boom during the 2006-2007 period, and Blackstone was looking to invest even more heavily. The firm would own more than 100,000 hotel rooms by the end of summer 2007. Blackstone saw an opportunity further to streamline the company and push Hilton's expansion overseas. They believed that they could add a substantial amount of value to the firm by expanding international properties and foreign hospitality offerings.
The Blackstone Group was founded in 1985 by Peter G. Peterson and Stephen A. Schwarzman and is headquartered in New York City. The Blackstone Group is a leading global alternative asset manager and provider of financial advisory services. Its alternative asset management business includes the management of several strategies, including corporate private equity funds, real estate opportunity funds, fund of hedge funds, mezzanine funds, senior debt funds, proprietary hedge funds, and closed-end mutual funds. In 2007, Blackstone completed a $4 billion initial public offering to become one of the first major private equity firms to list shares in its management company on a public exchange. The Hilton Hotel LBO had a total transaction value of $26.235 billion, with an equity premium of 40%. Blackstone financed the deal with $5.6 billion in equity from two of its funds and a few co-investors, plus around $20.5 billion from a group of 26 banks, which include Deutsche Bank, Morgan Stanley, Goldman Sachs, Bank of America, plus hedge funds, debt funds, and the Federal Reserve Bank of New York. Diving deeper into the LBO transaction, we see that the 26 other participating firms provided $20.2 billion in the debt structure. Looking further, we see that $8.6 billion was financed through mortgage-backed securities, or MBSs. An additional $11.6 billion was financed through mezzanine notes. That shows that Blackstone raised $5.6 billion in equity. With this amount, we see that 21% of the total transaction value was raised by Blackstone, and 79% raised by the remaining participants.
At the announcement of the deal, Hilton's stock was trading at $29.96. Blackstone agreed to a per-share acquisition price of $47.48, premium of approximately 40%. This was to acquire all outstanding equity. In addition, Blackstone took on approximately $7 billion of debt. On the left, we see transaction multiples, including transaction value to revenue and transaction value to EBITDA, that were significantly under comparables. In 2009, Hilton was sued by Starwood Hotels and Resorts with the claim that Hilton performed corporate espionage. Hilton had hired away executives and stolen more than 100,000 documents containing competitively sensitive Starwood information. Later, Hilton executives found the documents and returned them to Starwood offices unannounced. In December 2010, Hilton settled the litigation with Starwood for $75 million and agreed not to develop any hip modern hotels for 2 years. The documents that were stolen had related to a modern theme of Starwood's W hotels. In 2011, Raj Rajaratnam of Galleon Technology Fund was indicted on insider trading. He'd originally paid $10,000 for insider information, which had led to a gain of more than $4 million. Blackstone couldn't have picked a worse time to purchase Hilton, as the financial crisis sunk the economy soon after the deal. Blackstone Global Head of Real Estate, Jonathan Gray, reported revenues running down 20% and cash flows down around 30%. Though this was the case, Blackstone's long-term financing terms were based on a variable interest rate. Though occupancies dropped, interest payments dropped as well as borrowing rates declined. In 2010, Blackstone had the foresight to refinance its debt at fixed rates, taking advantage of the lowest borrowing rates available. This allowed Blackstone to survive where other real estate funds suffered through the financial crisis.
Blackstone benefited both from the restructuring of their financing in 2010 as well as a rebound in the economy from the 2008-2009 recession. The graph on the left illustrates Hilton's stock price once it announced that it would be acquired by Blackstone in July of 2007 up until the deal went through in October of 2007. 6 years after taking the company private, Blackstone decided to start cashing in through an initial public offering in December of 2013, and the graph on the right represents the stock price since this IPO. Today, with Hilton's growth, Blackstone is the largest hotel manager in the world with over 1 million rooms and an additional 200,000 under construction. The global hotels and resorts industry has rebounded from a recession-induced decline and experienced positive growth in each of the past 5 years. The infusion of tourist dollars has benefited hotels and resorts as room rates have increased, causing increased revenue growth to 5.3% over the 5 years to 2014, to roughly $720 billion. Before mid-2008, industry operations achieved solid profit growth due to robust hotel demand. Profit levels then fell from mid-2008 to early 2010. The industry's largest player, Marriott International, experienced a 23.7% increase in system-wide revenue per available room, or RevPAR, growing from $82.83 in 2009 to roughly $102 in 2013. Similarly, Hilton's system-wide RevPAR grew 19% to roughly $99 between 2009 and 2013. The graph on the left illustrates revenue growth in the industry from 2000 to 2014. The recessions in 2001 as well as 2009 are the only years in which the industry experienced negative growth. In summary, while there were many skeptics regarding the leveraged buyout of Hilton by Blackstone, such as Matthew Clark, a long-term Blackstone investor, saying that he knew that highly leveraged companies were very vulnerable, and when things are down that far, he was worried that if things got worse, eventually these things could go to zero. Blackstone was able to turn the company around during the recession of 2008 and 2009. As Chris Snow, an analyst at Credit Sites, said, they've done a real good job at improving operations. Blackstone was able to successfully turn the company around and turn the leveraged buyout into providing the largest profit in history of roughly $12 billion.